Kelly, thank you. And Carol Tomé, CEO of UPS, it's great to have you on. Thanks for being with us today.
Good to see you, Morgan.
So I do want to start with the fact that for fourth quarter, your earnings beat expectations, but it was really that full year 2025 revenue guidance and operating profit coming in weaker than expected. And then this news about Amazon and the fact that you're going to be tapering some of those volumes here through 2026 that has sent the shares lower. How much of the Amazon business piece of this is factoring into your guidance for 2025?
Well, Morgan, it's great to spend some time with you. And let me just talk a little bit about our Amazon relationship. We've been together for nearly 30 years. They are our largest customer, but they're not our most profitable customer. And the contract with Amazon came up for renewal in 2025, so we stepped back to take a look at where did we want to take this business going forward. Because if we didn't take action, it would have diminishing returns. So we looked at a number of different alternatives and decided that the best thing to do would to accelerate a glide down of their volume, taking it down by more than 50% by June of 2026. What that means in terms of the guidance is simply this. In the United States, our volume will decline in 2025 by 8.5%. Our revenues will decline by about 2%, but our profit will increase by 14.5%.
As you do grow margins and as you do seek out, and I'm going to get into this a little bit more in just a moment, some of these perhaps more profitable areas of business, have you been surprised to see the reaction in the stock today? I mean, UPS is having its worst day on record. I mean, we have in some ways seen this playbook play out before just a couple of years ago when FedEx disentangled itself from its own Amazon contracts.
So we had a big announcement today, and there was a lot for the market to digest. I think as the days and weeks come and analysts and investors digest our news, they will understand that we are taking control of our destiny. We are going to grow in the parts of the market that value our end-to-end network and value the capabilities that we have been investing in that differentiate us from the rest of the market. We are not a shrinking company. We are a growing company, but we need to take control of the Amazon volume.
How do you plan to backfill that volume as it comes down at Amazon, especially given the fact that the last time you and I spoke in March of last year on the heels of your Investor Day, you laid out this 1+2 plan and this better and bolder vision for the company?
Yes, so the 1+2 plan played out beautifully. We ended up with a lot of momentum in 2024, growing revenue and profit. As we think about how are we going to grow going forward, well, the U.S. small package market is growing in the low single-digit area in 2020-25, and we're going to take share. How are we going to take share? By leveraging the capabilities that we've been investing in. And I'll give you one example. We've seen great growth in our small and medium-sized customer segment. That segment reached now about 29% of our total business in the United States in 2024. And we're going to grow that to 32% in 2025 and then on our way to 35% by 2026. It doesn't stop with SMBs, however. We're growing into cold chain logistics. We just completed the acquisition of another cold chain logistics, healthcare logistics company in Germany known as Frigo-Trans. So our healthcare business was pretty growthy last year, and it will continue to grow in 2025. The healthcare business in 2024 grew 5%. In 2025, it's going to grow nearly 8%. And we're on our way to take that business to a $20 billion business by 2026.
Now, you've also said you're going to be reconfiguring the network. You plan to extract $1 billion in cost savings. How does that happen?
So there are different cost-out activities associated with the announcements that we made today. We have a lot of assets and resources that support the Amazon volume. And as the Amazon volume comes down, we will be freeing up resources and assets. We'll close about 10% of our buildings throughout the United States as an example of how we're freeing up assets and resources. And clearly, our staffing, well, it flexes with the volume that's inside of our network. On the Efficiency Reimagined announcement that we had today, this is about just improving many of our processes to take out costs. We've got some pretty archaic processes in our company still today. For example, we still take checks. So we've identified over $1 billion of cost savings just by running a better business going forward.
And then